Okay, so we haven't talked about Dave Ramsey here before.
No.
I know you guys, we don't like sit around and talk about him. Like every once in a while we'll share something that maybe he said. You're like, oh, okay, that's a good idea or whatever. But or not. Yeah. And again, that's just because of, everyone's allowed to have their own opinion, right?
Of course.
So we're going to start with that today, though. So Dave Ramsey says with Realtor.com, says pausing saving for your future to buy a house now, according to Dave Ramsey.
I know. That was pretty wild.
So this is from the guy who, he's talking all the time about like pay off debt, carry no debt, pay cash for everything, save money, and invest money.
Yeah. That's right.
But pause saving. Now, there are some stipulations, so let's not let the headline just tell the whole story because it's clearly not the whole story. So, as home prices rise, so do down payments, making it increasingly difficult for potential buyers to invest in real estate. And we find ourselves in a point in time where saving for that down payment, as well as getting your debt-to-income ratio to work to qualify, is most people's challenge right now. Yeah. And he seems to be meeting the moment where it's at. What do you guys think?
Yeah, I think he laid it out pretty clear. I mean, it's definitely a short-term play, not something that, you're going to do forever. But if you strategically are able to pull it off, then, you're going to be in a good position. I just think the way that, it came out, it's like, completely stop saving. No. It was more like, hey, take this period of time to kind of just reallocate your funds that you're already putting towards your savings account, but rather just, put them towards another savings account for your down payment. So I think it was a smart idea, but the way that they break it down actually gives you more context.
Yeah, no, I mean, Dave Ramsey, come on. Who would ever thought, go get in debt, right? Go buy a house. Usually you want to pay it all off. No, he's not always all about that. But it is pretty cool to actually see him be a little aggressive with this. He's very conservative. He's all about just, if you're going to travel, do not travel if you're broke and you need to pay off some bills. Is it a need or a want? And if it's a want, just ain't going to happen right now. So I do like that he just says right here, buy a house with your retirement savings. Essentially, I like what he's stating, put your savings for your retirement on hold because there is power in actually owning a home. And we already know statistically proven people who own a home, the percentage is really high where they're going to be financially well off when time for retirement comes. So I like that. And he's not saying, again, he's in the article, I like that it specifies that you're not to go and do this over a certain amount of period of time. He's strategically planning, you got to do it within a year, 2 years. That's good. You're probably going to have this feedback from your financial advisor, this pushback, right?
No,
what do you mean? You're going to take away from me? But, a lot of times, Andy, what we see most of the time when our clients come in and we work with a lot of military. They go into their TSP, right? And when you ask them, can I get a quarterly statement? They're cool to provide that, and then when you see what they're doing, there's no aggression there. And you're like, well, wait a minute, man, they're like Brian's age, right? 16 years old. No, I'm sorry, Brian. But no, they're like, they're young. They're in their early 20s. It can be a little more aggressive because remember, when it comes to investing in the market, it's time in the market, not timing of the market. And sometimes we feel that fear of missing out. So he does say right here, it's going to be about a 2-year plan.
Yeah.
And so the pushback from the financial advisor is going to be, well, you're not going to have that compounding interest in that. But the power with real estate, remember, if you're buying a $400,000 or $500,000 home and you're using a 3.5% for FHA or 5% with conventional financing, a minimum down payment, even 3% with conventional financing is possible, you're also going to have that same compounding effect when owning a home.
Yeah.
So it kind of reverses that.
Yeah, I think the couple things that stood out to me in this is the advice to but put a pause on the retirement investing.
Correct.
Because their point here, it's money you're saving anyways. You might as well use to buy a home, which is equally investing in your future. So it's kind of like you're putting it in bucket A versus bucket B, and bucket A has an appreciation that's connected to the market directly, and bucket B has one that's connected to the market directly/indirectly via real estate, which is also the place you're living in. Yeah. So if you're going to, pay a really exorbitant rental amount every month, well, if that's the equivalent of a housing payment and you can save for the housing payment, I totally see his point here.
Yeah.
And this makes sense because in the example of saving $1,700 a month for 24 months, let's just say let's say a young married couple, both contributing or combined contributions are $1,700 a month. That's just over $40,000 in a 24-month period, which in most parts of the country, that's going to get you in the door.
Yeah. And, another thing that actually talks about here on the article is he also says, do not borrow or cash out your retirement because these do come with penalties. California, I think it has one of the lowest, where you get penalized. I want to say it's like 10%.
Yeah.
So we have one of its lowest, but that's not what he's saying here. What he's trying to say is, like, if you're contributing to it right now, like, and you're thinking of purchasing a home, just put that on pause.
Yeah, redirect it to another account that is kind of your slush fund, if you will, that becomes your down payment.
Yeah, because, the point that he was trying to drive is that although you're not going to be continuously, contributing to that, you still have what's in there basically writing out. So if you pull that, then you for sure have nothing compounding at all.
Yeah, you're minimizing the base that's already earning interest in its position. Just redirect it to somewhere else for a short period of time. And I want to emphasize that. Like, this is not the permanent solution because, again, obviously, because once you use those funds to buy the house, guess what? You can return to putting it back into retirement. And again, I know I'm somewhat surprised by this, but I'm also not, because if you take that long view, like you were just saying, that he also tells people to get in the market early, and then you can ride that you can afford for 2 years to save, because on the long timeline of 20, 30, 40, 50 years, what's 2 years relative to all of those?
Exactly. Yeah.
So there's a lot of catch-up provision, and at the same time, even though there's ebbs and flows in real estate, there's ebbs and flows in Wall Street, you're going to ride it out in one of or both of those parts of the financial world.
And another point that comes up to that is, like, if you stay in the house, let's say for a good 5-6 years, and then you decide, hey, now I'm going to sell, you can then take some of the profits for yourself and replenish back your retirement account, so down the line
it's not really a replenishment, right? Because he's not asking you to take money out or withdraw from it. So what he's actually, the cool example there is he's giving a $40,000 example, and he's saying if you were to actually save $1,700 each month in 2 years, you'll have $40,000. Does that math?
Yeah, it's $40,800.
Yeah, there you go. See,
I actually did it before, so I didn't do that live. I was like, I better calculate this to know the number in case you did that exact thing right there. What is the total?
Because you're a mathematician.
40,800.
And so that's good advice. Seeing that in the beginning when I read that, like, Dave Ramsey, what you're gonna buy? You have to read the article, because what he's all about. You're not going out there and getting into more debt. This isn't acquiring more debt. What this is showing you is save, so that you can get into that new debt. And it's going to allow you to just comfortably put yourself in that position. But here's the mistake, and I know we talked about a couple of weeks ago about the myths and stuff like that with VA. The other myth is misconception with people. Back in the past, most people thought you had to buy a home with 20% down. Yeah. And that's not the case. What it is, you can buy as low as 3%. You just have what's called as mortgage insurance. It's an additional payment on top of your monthly mortgage payment. It's all it is. And sometimes, depending on your credit score, that could be a very low payment.
Yeah, that might be the only way. And that's also where maybe you have to break from the advice in this article too, because the suggestion is if you can keep your total housing payment to 25% of your gross income.
Yeah,
I'm like, what? Well,
not here in California.
Most people, they're getting 45 or higher in a lot of cases. So I think that's the exception where we'd go, hey, you might have to break from that advice in the article. Up until this point, man, the suggestion in his blog is pretty solid advice. Again, given the current environment and the landscape of real estate, the affordability challenges, and just the way that property values are holding because of inventory issues, I can't find fault in his approach, because I know, or what I do know about him is that he's saying that within the context of returning to your previous saving and investing habits once you've accomplished the homeownership part.
Correct.
So if you're going to follow that plan, then 2 years is what, over a 30, 40, 50-year time frame. Yeah. Not that much.
No, exactly. Yeah. And go ahead.
One thing I just wanted to mention is at the end of the article, and I'm sure this was not on purpose, but I just want to make sure for everyone watching, it talks about, hey, there are some zero down payment options, and it goes on to talk about like USDA and rural loans. Yeah. Guess what loan was missing?
VA.
VA. So Realtor.com, if you could please go ahead and when you do an article, edit on that. Let's go ahead and add VA in there, because it's actually more widely used than USDA. But who are we? Just three guys that talk about VA all the time.
And it has one of the least defaulted,
the lowest default rate of all loan types in the entire industry. So there's that as well. Anything else on this one, guys?
No, I mean, I'm just glad that he's saying, go acquire good debt.
Yeah.
This is good debt. Before he used to be like, even with homes, I don't remember him being,
It's like the only acceptable
Right.
debt, but also have like an accelerated payoff, which, by the way, for people who don't know, we have a mortgage accelerator payoff calculator, which we can share with people. So if you are interested in paying your house off sooner, we actively show people how to do that. About Dave Ramsey, I just wish I could get into one of his brothers' restaurant, Gordon Ramsay. It's actually, they're not brothers, but I wish they were. That'd be super cool. We could interview them both at the same time over a great meal, talk about finances, right?
I'm like, wait a minute. What?
Yeah. Gordon Ramsay, man. They both yell at you. One's yelling at you about debt, and one's yelling about you using too much spices.
Idiot sandwich.
Okay, I'm killing this segment. Next segment.